400%. So as rates begin to rise, McDonald's has to begin to think, I have to pay more in interest servicing than I did a year ago, 2 years ago. I'm not going to spend as much in capital expenditures. So my theory is that you've seen the bump from the capital spending incentivized tax cuts, but you're going to start to see companies have to divert their capital spending budgets towards interest repayment. And that's for the AAA companies. Let's begin to talk about some of these idiots that have been buying real estate at 3-4% cap yields.
Hold on, before the idiots buying real estate, so companies taking on a lot of debt at these historic low rates has been used often to buy back their own stock. But the idea now is you're saying that that's going to be diverted to interest rate payment on this debt, and that there's a lot smaller companies, however, when it comes to their exposure to debt, but they are taking on a lot of debt. How is this going to play out kind of on the wholesale market? I mean, you take a country like Japan, they are 300% debt to GDP. They've run through all their domestic savings. Now they're out looking for more credit. They're credit starved. If you look at the geopolitical picture, what's the soft spot? I mean, Italy is obviously a basket case, but isn't like Japan potentially where things start to get in trouble?
Well, people have been calling for the demise of Japan for 30 years. That trade has been a widowmaker. My view on Japan is that they have a very large surplus of water and grains, and then they have taken over critical parts of the supply chain for the automotive industry. And they also have very important offtake agreements for all the most important metals, whether it's copper, zinc, and lead, and tin. So that's why people always misunderstand Japan. The first cause is Japan is an export-driven country, so people need their exports. And I think that's what allows them to always devalue the yen. But if we take a step back to your comments, the single most important thing there is that I don't see a scenario where the rest of the world can have 0 to negative interest rates while the U.S. has 3% rates. That simply won't last. And it's not a function of just the U.S. dollar rising versus these currencies. There really begins to be a question of what companies can afford to pay 3, 4, 5, 6%. Tesla bonds are trading at 9%. Elon Musk is already losing all this money. There's no way he can build out his dreams with 9% interest rates on $30, $40 billion of debt. So I do believe that while the gold bugs have been wrong about this idea that rates couldn't rise to 3%, and by the way, I was one of those people that didn't think rates could rise to 3%, and I've openly said that I believe rates are too high. I think they've raised rates way too high, way too fast, and I don't think you're going to see rates go much higher because I believe that it takes a few quarters for the oil in the sprockets to essentially grind to a halt. And that's what you're seeing. So rates have risen. People are starting to think about these things. It's also affecting the way market participants allocate capital. Why would you allocate capital towards high-risk investments when you can make a 3% risk-free yield today, 5% B+ bond yield? So I genuinely believe that the gold story, as it relates to gold, is where right now gold could easily drop to maybe $1,200 an ounce, maybe even $1,150. But at a certain point in the next 3 to 6 months, it's going to be clear that we can have no more tightening. We can't tighten anymore, and we have to start dealing with the next crisis. And the next crisis is going to be very, very interesting because you don't have a global coordinated desire to cooperate. You have everyone looking out for their own self. Every country looking out for their own, and you have a very, very aggressive Trump who, by the way, he's also implementing 10, 20-year plans. We haven't seen that in U.S. politics forever.
So in 2008, we saw something similar where Lehman and the Bear Stearns were sacrificed because there was no will to cooperate ultimately. Lehman was like, no, we don't want to be part of this bailout. So they were sacrificed. So you're saying this could happen out on a global basis where these central banks to say, you know what, we're actually in it for ourselves. We're not going to go.
I don't think the euro will survive the next crisis because I think that the euro is so vulnerable. Spain raised debt the other day at 0.3%, or a 0.3 negative rate. That makes no sense.
What about Argentina's 100-year bond?
Well, again, Argentina is one of these basket cases where, every few years they just devalue the peso and they just destroy their labor force and they destroy their population's ability to achieve any form of long-term prosperity. But I think the euro is more interesting because there are cracks beginning to manifest in the relationship between the various members of the European Union. And I think that when Europe simply cannot work with 3% rates. Greece can't work, Italy certainly can't work, Spain can't work. So the next crisis could, almost in a weird way, see the United States do okay. They will have a debt deflation, they will have a real estate bust, like we haven't seen in a very long time. But it could be like the early 90s or the late 90s where, some of these real estate guys just get wiped out finally because they got bailed out last time. But where the real shocks are going to emanate from EU, emerging markets, sort of like we saw with the Asian crisis, I believe in the late 90s.
All right. Hold that thought. We were going to get very close to the gold, but this is just a big setup. It's setting the table. Now we're going to dive into gold, if you can stay for another segment.